Welcome to Striking Option, the show that reveals the options you have to better navigate markets. I'm Jeff Kilberg, and I'm joined today by Bob Icino. Welcome, Bob.
Thanks for having me, Jeff.
Well, it's hard to believe Memorial Day weekend is upon us, Bob. We have made it through earnings season better than expected. We also have the FOMC minutes this week being released on Wednesday, and of course, we have continued trade deal tensions mounting. What are you focused on, Bob?
Well, I'm glad you mentioned those FOMC minutes. Generally, they're rear view mirror in terms of the information, but given that discussion was had prior to the trade tensions ramping up, I'm really focused on what their mood was.
And I think we'll talk more about this later in the show, but the interesting move by the Fed in December, that dovish tilt, really is supporting markets here at this 2,800 level, correct?
Yeah, it is. And again, with the trade tensions ramping up, it's very good timing.
All right, pal, let's get in this first lightning round. You ready?
I am ready.
Gold losing its luster. It has been an interesting trade. All of 2018, you saw a bid in gold. Now all of a sudden, you're seeing a little weakness under 1,300. What's moving gold?
Yeah, I think gold was a flight to safety trade, and that's not completely out, but the premium's been taken out.
It's interesting you talk about premium. We talk a lot here on Striking Options. Are we a buyer premium? Are we a seller premium? So what type of trade example would you utilize as we're here and now around 1270 in this Goldie mini contract?
Well, I'll tell you, this is close to at the money, but I really like the 1265 level. So what I'm going to do is I'm going to look at an example of selling the week 5 gold 1265 puts. You can sell that for about $240, and I'm going to buy for protection on the downside the 1240 put for $30. The selling of this put spread allows you to collect about $210. And again, I really like that 1265 level. We've got some support at 1269 and again at 1264. The 1265 option is a great place to go long if you actually want to do that.
And I think if you look at a chart, you see this range-bound trade, and it's really interesting. We talk about gold, but we also talk about the U.S. dollar and that strength in the U.S. dollar. It seems like the Fed wants that dollar to kind of stagnate or essentially not get above 98. As long as that doesn't get above 98, it seems like the range will persist. Is that correct?
It is, and that inverse correlation between the dollar and gold will take hold all else equal, but there's quite a bit going on in that 1265. That's the top of the old range in gold.
And important to remember, this put spread that Bob's talking about selling expires on Friday, May 31st. And the August futures was the underlying contract at 1277 was the price, and the at-the-money vol was around 8, Bob.
Yeah, again, a good place to get into that. That's pretty low vol for gold.
Yeah, absolutely. Well, please remember that these are trade examples, not trade recommendations. But if you're ready, Bob, we're going to get into the second lightning round.
I'm ready.
Markets bounce. Well, we have seen a lot of headline, all the conversations about the trade tensions or the trade deals between the U.S. and China. Today, all of a sudden, we're seeing the tech resurge after the whole Huawei conversation is allowing about a 90-day kind of reprieve. So we're seeing a lot of volatility specifically in the E-mini S&P 500. What's your takeaway?
Yeah, I really like what's going on here from an equity perspective, simply because it's the typical playbook of this administration. There's an issue and then a delay of that issue. So the volatility, I think, is going to persist.
And as long as we see volatility, the trade example I want to approach the market, because one day we're happy, one day we're sad. We're seeing a lot of moving parts, and we're one tweet away from the market going lower or potentially higher. But I see a range, and potentially a range, Bob, going all the way out to that G20 meeting, the end of June. So the trade example I want to utilize, I want to sell a call spread. We talk about selling premium, we talk about buying premium. But again, we want to be a seller here at this 2,900 level in the E-mini S&P 500. So I'm selling the 2,900, buying the 2,950. And this is interesting because the 2,900, not quite at the money, Bob, but nonetheless, that has been the high end of the range. So I'm going to collect about $550 for that strike I'm selling, that call I'm selling, and buying that 2,950 for only about $60. So it's really important to understand why I'm picking these levels.
Yeah, what I really like about this trade is the tight range, 29 to 29.50. It's not going to spike higher dramatically. It'll grind higher, and this gives you room for that to actually happen.
That's right, and this goes out, this trade is expiring next Friday, May 31st, and the June E-mini S&P 500 futures contract was trading at 28.69, so about 30 handles lower than the initial strike I'm selling, Bob.
Yeah, and at the money volatility is at about 14.12 on this one, which is also fairly low.
And as we talk about, the Warren Buffett approach to investing, we are going to be a collector here on this premium. So we're hoping to collect nearly $490 on selling this call spread. And it just is an interesting moment in time. We're trying to use the range provided. I know we all want to trade the markets we want, but we have to trade the markets in front of us sometimes, Bob.
Yeah, and again, I see more downside than I do upside in the short term. So again, the dating of this particular example is really good.
All right, Bob. Well, thanks as always for hopping on Striking Options. We also want to thank you for tuning in. And please tune in every week as we will continue to strike options.